In finance and clinical trials, the hazard ratio helps us measure the relative risk of an event happening over a specific period of time. At its core, a hazard ratio is a way to compare the likelihood of an outcome between two different groups. Think of one as your neutral starting point. If the ratio is exactly 1, it means both groups have the same level of risk. When the number is above or below 1, we start to see a divergence in risk trends between the two groups being analyzed. While risk ratios look at the total outcome, hazard ratios are more useful because they account for when that outcome actually occurs. This chart shows how different groups might be categorized based on their hazard ratio compared to a standard baseline of 1. Remember that this is a relative measure. It describes the relationship between groups rather than the absolute probability of an event. Understanding these metrics helps you better interpret research data. Thanks for watching, and stay tuned for more basics on financial analysis.